What does conservatism in financial accounting mean? Conservatism in financial accounting is a principle that guides the preparation and presentation of financial statements. According to this principle, when there is uncertainty in accounting estimates, accountants should choose the alternative that is least likely to overstate assets or income and instead, opt for the alternative that is more likely to understate them. In other words, when faced with two solutions for accounting challenges, the one that yields inferior numbers, i.e., lower net income or lower asset values, should be selected. Let's break down how conservatism works. Recording losses and liabilities. Conservatism emphasizes the need to recognize losses and liabilities as quickly as feasible. If there is uncertainty about incurring a loss, accountants are encouraged to record it and amplify its potential impact. This cautious approach ensures that a company's financial statements reflect a worst-case scenario. Liabilities and expenses are intentionally overstated to account for potential losses. Recording gains and revenues, on the other hand, conservatism advises accountants to ignore potential gains until they are actually realized. Revenues are reported in the same period as related expenses were incurred. All information in a transaction must be realizable to be recorded. If a transaction does not result in the exchange of cash or claims to an asset, no revenue may be recognized. Understating gains and overstating losses. By understating gains and overstating losses, accounting conservatism will always report lower net income and lower financial future benefits. This approach ensures that financial statements are accurate and truthful, even in uncertain situations. In summary, conservatism helps maintain financial reporting integrity by erring on the side of caution and providing a more conservative view of a company's financial position. If we must choose between lower net income and lower net assets, which one is the more appropriate choice, following generally accepted accounting principles? When following generally accepted accounting principles, GAAP, the more appropriate choice between lower net income and lower net assets depends on the specific context and the accounting situation. Let's break it down. Lower net income. If faced with a choice between lower net income and lower net assets, GAAP generally favors lower net income. This is because GAAP prioritizes conservatism, which means erring on the side of caution. By choosing lower net income, companies are more likely to recognize losses promptly. This conservative approach ensures that financial statements reflect a worst-case scenario. For example, if there is uncertainty about the collectibility of accounts receivable, GAAP would recommend recognizing the potential loss by reducing net income. Lower net assets. However, there are situations where choosing lower net assets may be appropriate. For instance, when valuing assets at their fair value, which may result in lower asset values. When there is a need to write down the value of an asset, e.g., due to impairment. When accounting for depreciation or amortization, which reduces asset values over time. Balance and context. Ultimately, the choice depends on maintaining a balance. While conservatism leans toward lower net income, it's essential to consider the overall financial picture. Companies should apply judgment based on the specific circumstances, industry norms, and the purpose of financial reporting. References. Accounting Conservatism, Definition, Advantages and Disadvantages, Investopedia.com. Visit. What is conservatism in accounting? Live well. Visit. Accounting Conservatism Overview, How it Works, Examples, Wall Street Oasis. Visit.